Hi, here today to talk a little bit about charitable giving and different strategic charitable giving planning strategies that we really enjoy speaking with our clients about and putting together for folks. And it's a great opportunity to learn a little bit and to share some of the conversations that we're having with our clients as far as how they can make a larger impact with their funds and within the organizations and causes that are most important to them. So to get started, I like to think about money and very similar to the pyramid of needs. At the very baseline, we have our basic needs when it comes to money. So the most important thing, I need to have enough money for today and for tomorrow. So cash flow. Can I pay rent? Do I have clothing? The essentials are taken care of. And once we have that nailed down, it's really where we say, okay, our budget is okay. We've moved maybe beyond paycheck to paycheck, and we're ready to take the next step into what we might call financial security, where we're really starting to be able to think about tomorrow, a few months down the road. We're building up that, general rule, 3 to 6 months of an emergency fund. We're able to make sure that we afford basic insurance, good auto coverage, homeowners, all those different pieces of the puzzle that we can certainly get into. And then the middle tier is really more where we can start to look at different long-term planning techniques, really starting to have an impact that compound over time. So we're being very strategic about paying down debt. We're investing for the future. A lot of times it makes sense to take a tax-aware lens to that. Do I want to be saving into a Roth 401k, traditional 401k, IRAs, et cetera? We're also saving for longer-term goals, maybe saving up for a down payment on a house, where maybe saving up to go on a big vacation, whatever it is that it's important to you. That's really part of what fits into that building wealth tier. And then the second to the top, financial freedom. So this is where we're really building towards, I can do what I want with my time, right? Maybe you're not necessarily retiring, but you have the ability to retire when you retain financial freedom. We're doing some of the extra things like helping out family, whether it's kids or extended family with education, vacations, et cetera. And where we're focused today, the legacy piece is, I think, the most rewarding place to have these conversations and where we can really make a big impact, where we're talking about not just within your family in terms of estate planning and how your money is distributed out to your family when you're no longer around, but also charitable giving. And we really like to emphasize that you have the ability to make an impact while you're still here. You don't have to wait until you're dead and it's being read out in your will or in your trust documents for your money to go to these causes and these people you care about. So today's overview is really focused on what are some of those strategic proactive things that we can do. And some of them are more geared towards planning for today and what money am I giving to different causes today, tomorrow, next year, et cetera. And then there are a few that fall more into that estate planning piece of what happens to the assets that you leave behind. And some of those can be meaningfully more strategic to leave to charity versus leaving to family, for example. Major items we will hit on in walking through this, some basics around just cash giving. Even though we're maybe just writing a check or handing over cash, there are still a couple of things to keep in mind, particularly when it comes to taxes, that it's good to be aware of. Now, I think it's important to state that it's always okay to give money to charity. Sometimes we can be a little bit more strategic. And so this is more for awareness, but certainly there's nothing wrong with giving $5 to the Salvation Army kettle at Christmas time. I just wouldn't consider that real strategic in terms of the way we're thinking about it. How do we give out of our retirement assets while we're still alive, particularly when we reach certain ages? There are opportunities to give from there. And then as part of our beneficiary designations, how can we use our retirement assets for really significant tax advantage when it comes to giving at the end of life, giving appreciated assets, classic example of a stock or ETF or mutual fund that you bought many years ago and has done very well, maybe too expensive to sell that and pay the taxes to rebalance. So maybe we want to use that as a way to give to charity, and then can couple that with a donor advised fund for a really powerful combination. Legacy giving, estate planning, advanced strategies we'll touch on briefly. at the end as well. The simplest one here, cash donations, one time or recurring. And one thing that has become a little bit more important with some recent tax law changes is the idea of bunching our donations into particular tax years. So a lot of times what this means is maybe you're somebody who generally is going to be taking the standard deduction, especially since they've increased the size of that standard deduction in 2018. And then also most recently have added a minimum threshold for deductible charitable giving of 0.5% of your adjusted gross income. So these things kind of work in tandem to make this tax smart bunching a little bit more important. You can see here in this side by side of if we give, say, $20,000 to charity over the course of 2 years, we can see the relative projected difference in the total deduction we receive. On the right-hand side in option 2, where we're saying, hey, maybe we bunch all $20,000 to perhaps the end of the year, in this example, 2024, versus giving across 2024 and 2025. So just an indication of how sometimes stepping back and thinking, if I'm going to give this much to a cause or a handful of causes, timing may make a difference, especially as we get towards the end of the year, to say, maybe let's wait a little bit, or maybe let's go ahead and call that charity we're giving funds to and say, hey, I'm going to write your check in December. It's for this year, and it's also going to cover everything we're planning to give for next year. And the charity or organization is generally more than happy to have the money a little bit ahead of time. Moving on to giving with your retirement assets. So generally speaking here, we're talking about an IRA, an individual retirement account. And the most powerful way to use that to benefit charity when you're in your retirement years, once you're over age 70 and a half, you're able to start doing what's called a qualified charitable distribution. And effectively, this means that you can send a check directly from your IRA account to a charity of your choice, as long as they're a qualified charity. And that can also go towards your required minimum distribution. And the reason that's important is that this doesn't count as taxable income to you. So if we look at the example of just writing a check out of our checking account to an organization, we're able to get a deduction under certain circumstances above the 0.5% of our income. But if I give out of my IRA, that's money that's not taxable to me at any point in time. So it become more efficient for you, especially once you reach your required minimum distribution years, because for most folks now, those are going to start at 74 years old, because maybe your required minimum distribution is $70,000. Well, you'd now be able to say, okay, I'm going to give money to charity anyways. I can maybe contribute $50,000 to a charity. I'll do it from my IRA. And now I'm only going to have to take $20,000 of taxable income from my IRA this year. And that can be a really powerful lever for you when it comes to controlling your income over time and maybe staying in a lower Medicare premium band, maybe staying in a lower tax bracket, all sorts of different pieces of the puzzle that can fit together when it comes to tax planning. Another great way to use our IRAs, beneficiary designations. So particularly when you have an IRA that's going to go to the next generation, right? If we have an IRA that's going to go to a spouse, they're generally able to just take that under their own name and no special rules apply. So they still have their life and to spend that account down. But when IRA funds start going to the next generation, we now have what's called the 10-year rule, which effectively means that whoever inherits that account is going to have to empty the account over the course of a 10-year period. And that's going to be taxable to them at their marginal income tax bracket. So if you have a kid who's making, probably an adult child, who's making $150,000 per year or so, and they inherit $1 million from you in an IRA, they're going to have to empty that account over 10 years. And every dollar they take is going to be more income on their tax return. So effectively, if they're in the 24% tax bracket, if we just apply level taxation over time and don't account for any growth in the account, the net benefit to them would be about $760,000. So of your $1 million that went to your children, maybe only $760,000 actually went to you ultimately wanted to go to, with the other $240,000 or so going to the IRS. Now, if instead you were to give that to a charity of your choice, the charity doesn't pay anything in taxes. So now that $1 million, full value of it has gone to the cause or causes that you care about. And we're then being strategic with saying, here are the other assets that are going to my heirs. So maybe assets that have better tax advantages, your after-tax investment account where they would receive the step-up cost basis, or maybe a Roth IRA where they still have to empty it over 10 years, but they never pay taxes on the growth and the money that comes out of the account. So that can be another very powerful way to reduce your overall tax impact and also maximize the relative impact of your dollar for the causes that you care about. The next on our favorite techniques for charitable giving can be very simple, and it's just giving appreciated assets. So most charitable organizations have the ability to accept stock or other investment fund donations. And if they don't, it's relatively easy to set up. If they've got a bank account already, it's about the same information for them to work with an RIA or an advisor to get an account set up to accept those donations. So similar to when they receive an IRA as a beneficiary, the charity doesn't pay any taxes on appreciated assets that they sell. So if they were to receive a donation of stocks, and maybe you bought something for $10 a share and now it's worth 50, if you were to donate that to the charity, they're able to turn around and sell it, receive that $50 per share, but they don't have to pay any tax on the $40 per share of growth. So particularly if you're looking at donating money and thinking, well, I maybe had to sell some of my investments in order to fund this, it's much, much better to say, well, let me just go ahead and donate this investment to them so that they can sell it and not pay taxes. You're going to receive the full deduction amount for the market value of that asset as well. So you don't have to pay capital gains tax. You get to take the deduction based on the full fair market value of the asset that you donate. And particularly where we really like using this is when we're already in a situation where we need to be rebalanced portfolio. So as part of that overall diversification and approach to managing risk and return over time, you may look and say, particularly in this environment, a lot of these tech holdings have made a lot of money, and maybe we want to trim that a little bit. It's maybe better for you overall to say, let's donate a portion of these rather than taking the taxes to go to the rest of our portfolio. Donating appreciated assets becomes even more powerful when we couple it with what's called a donor advised fund. So a donor advised fund provides structure, flexibility, and long-term planning around charitable giving, most meaningfully because it allows you to bunch the tax benefit of your donations into a single or a few tax years. So effectively what we're doing is we open an account that's registered under a not-for-profit, and you are then able to donate cash, stocks, other appreciated assets, even things like real estate or minority interests in businesses into that fund, into that account, which is a charity. So it's able to sell those, diversify them without you incurring any of those capital gains. And then you have the ability to recommend grants from that. So we can say, okay, I'm going to donate my appreciated stock into this donor advised fund. Maybe I'm donating $200,000 or $300,000, and I'm not really sure where I want it to go yet, but I know that I need to get some tax deductions for this particular year. So we can now keep it in that account, invest it, and then over time recommend, hey, I want to give $10,000 to charity A, $50,000 to charity B. And these funds in that account will continue to grow tax-free over time while you're able to continue giving out. So it's almost like you're creating a miniature foundation, although much simpler, much cheaper for you. And you can even over time add your family as folks who can eventually take over the recommendation of grants and really turn it into a powerful tool for purpose within your family. And then finally, just to touch high level on a few things, we can also always name charities in your will, name charities in trusts, and other things that are really important to think about within legacy, powers of attorney, healthcare directives. And we always want to be checking beneficiary designations. So a good general rule that we say is we want to make sure that you're reviewing your estate plan every 3 to 5 years. And while we don't do that directly, we're very closely with a lot of very good attorneys who can help inform. And maybe they say, hey, we're in great shape. We don't need to make any changes. Sometimes it's time to update things because rules have changed or situations have changed. Most meaningfully, maybe children of yours who were treated as children in previous drafts are now grown and have their own families. It's really important to make sure that the documents are reflective of that so that your actual wishes are carried out as part of your legacy over time. So when it comes to the question of giving today or giving tomorrow, it's always important to step back and think what makes most sense for me and my situation. And tax timing can make a really big impact on those decisions because tax brackets are marginal and because there's a lot of different kind of nuanced factors in the tax code, things like certain threshold where capital gains is zero, or just we want to stay below a certain marginal bracket because the next jump up from 24 to 32 is pretty meaningful. If we have an unusually high income year, whether it's because we've sold our business, we got a really big bonus, done a Roth conversion, or any number of things, timing your charitable giving alongside that event can be really, really powerful in terms of your long-term wealth net of taxes. And so, or to reiterate, the right year to give to charity is often your highest income year, not the one where it's most convenient to you. Again, to circle back to that donor advised fund, that's one of the really nice features of it is allows us to say, okay, I'm going to get this taken care of during this high income year where maybe I have a lot of other things I'm worried about. And then it'll be more convenient for me over the next 3 or 4 years to decide, here's now where that money is going to go. And another thing we'd emphasize, your legacy doesn't have to wait. Really like to encourage folks to be proactive and make sure that you're able to see the difference that your money is making. And whether that's giving to family members, maybe you're helping your adult children with a down payment for their first house, or giving that big charitable gift when you're still around to see the benefit of it and see the people that you're helping. A good plan aligned with your purpose is one of the most powerful things that we can do and that we love working on together with our clients. So if there's anything that we've covered today that's interesting to you, if you'd like to know more about it, or if you just have a couple of questions, please do reach out to us. Visit us our website, www.gainlinefp.com, or reach out to us, team@gainlinefp.com, and we'd be more than happy to chat and answer your questions.